This video will not make you a better trader, but it will help you recognizing yourself in the next 30 minutes. You try not to take it personally. I didn't. Most trading content tells you what to do and what not to do. The usual: be disciplined, protect your psychology, and make sure your technical analysis is on point. Yeah, and all this is the stuff you're already doing, so you don't need more official advice, because clearly the unofficial one was not landing. So 10 rules, and I promise that if you follow them, you won't just fail, you would fail in style. So rule number 1: treat risk management as a suggestion as opposed to something you should be doing religiously. All these people, they trying to claim that you have to risk 1 to 2%, and these are people who obviously do not understand what your ambitions are or what your tolerance for risk is. So they don't understand you, so why should they be telling you should be risking 1 to 2%? So if you want, you can go ahead and do the 5%, 10%. It's what's the worst that could possibly happen. You lose an account, you get another account if you're trading problems, or you lose your account balance and you get more money to put into that account to lose again. So the whole idea and hassle behind risk 1 to 2%, it's not necessarily something you should be. If you want, risk 10%, 20%, 50%. If you are feeling truly free, risk an amount that you'd be ashamed to tell somebody that you lost afterwards. You need character to live better in any field, and nothing builds character like margin calls. 2. Revenge trading. You just lost. The correct thing to do is sit back, reassess what you just went through, check where you went wrong, and maybe close your system, come back another day. The incorrect response, and therefore the one we're covering, is to re-enter immediately, same direction or opposite. It doesn't matter, with a bigger size if possible, because the market owes you something, and you must collect that something back. This is not trading. This is an argument with a candlestick, and you will lose the argument. The candlestick, it has never lost an argument. The third one: get your trading advice from an account with a Lambo on the display picture. Due diligence is checking if your guru has an actual track record. Due diligence is not checking if his Lambo or real or fake. If he's claiming ex-Wall Street employee, but the grammar on his bio is claiming otherwise, that's not just a red flag, that's a discount. Pay for the signal group, copy the trade, and when it doesn't work, that's fine. There's another guru, and he also has a Lambo, possibly the same one. Okay, I feel like on this one I should remind people that this is for comedy purposes only. So don't go out and cut out this part and then say that so person said this. So I did not. 4. Use your demo account like it's a casino with fake chips. On demo, you're a genius. No fear, no hesitation. Instant entries, because losing fake money feels like losing nothing. Then you go live with real money, and then you realize that your strategy is just the absence of actual consequences. The lesson here isn't that demo doesn't work. The lesson here is the fact that you never traded demo like it was real. So you never build the actual skill that matters, not flinching when the money is yours. 5. Move your stop loss when you're losing. 5. Move your stop loss instead of taking the loss. A stop loss is a promise you made to yourself before emotions got involved. The good news is you can break promises to yourself with zero paperwork. Just drag the line up and down as you deem fit. The trade isn't wrong, it's just early. It will eventually reverse back. It is in fact always about to come back until the account is blown, or you get that email from your favorite platform telling you that you have just breached one of their rules. Your account has been breached. And this is like the closest thing FX can be to horror movies. The fact that don't worry, it's okay, it's fine, it's fine, it's all going to be fine. It's always said right before everything goes to shit. This is much. Number 6, trade the news before you understand the news. NFP just dropped. You don't know what NFP stands for, what the numbers mean, or which direction it's supposed to move the pair. But you know that the folder is red, it's high impact, and high impact somehow means go for you. Enter on the first candle. The first candle is famous for always being a trap. You will not be the exception. Nobody is ever the exception. 7. Add to a losing position, because it always comes back. So I'm assuming that most of us are familiar with the concept of averaging down, adding to your positions the more signals you see. But the problem is that it can also be called making a small problem bigger. The market doesn't know your entry price. It didn't ask, it doesn't care, it will not start now. But sure, Buy more, average down, increase your blood pressure, and the two will not be permanently linked. 8. This is literally getting out of hand. Follow every signal group simultaneously. I mean, the logic is simple, right? Why have one strategy when you can have 9 or 10 all buzzing your phone saying they have contradictory entries at 8 a.m. Take every signal, stack every trade, and if 3 of the signal groups were to differ on what directions to follow, that shouldn't be a red flag. That should be diversification. Okay, that is in fact the opposite of diversification, but it feels busy, and busy feels like progress, so let's feel busy. Rule number 9. It was supposed to get to 10, but I'm getting tired with the hand gestures. Never journal, never review, just vibe. A journal will show you the pattern. Same mistake, same time of the day, same. This time it's different energy, so don't keep one. Memory is unreliable in exactly the way that is convenient. You remember the one in vivid details, but you forget all the 11 losses that paid for it. So sarcasm apart, if you recognized yourself more than twice, that's not an accident. Here's the part I'm supposed to tell you to do opposite of everything I said. Fine, yes, obviously, do the opposite. Risk small, let losses be losses. Get strategies from people who show they are losing trades too, not just the Lambo. Trade your demo like the money is real, because the only thing that demo cannot replicate is your own discipline, and that was the only thing that was actually being tested. I've done at least 6 of these 10, some of them twice. The market doesn't care that I know better, it only cares about what I actually did. If this sounded uncomfortably specific, you are not alone. That's basically every account that has ever been blown. Subscribe so I will keep making the mistakes so you don't have to. I mean, it probably won't work, but that's what I'm selling.